Traders. Do you know that smart money concepts refer to strategies and methodologies used by institutional traders or experienced investors to navigate and capitalize on market trends? Understanding these concepts can provide significant advantages in financial markets. Here's a detailed breakdown of why smart money concepts are important. 1. Smart money concepts gives an institutional insight. By identification of big players, SMC helps traders identify and follow the activities of institutional investors who have significant market influence. Understanding these patterns can provide insights into market direction. Volume analysis. Institutions trade large volumes that can move markets. Recognizing these volume spikes helps in anticipating potential price movements. Example: if a stock experiences a sudden surge in volume without corresponding news, it might indicate institutional buying or selling, which could foreshadow a trend change. And that's why, in this video, I will briefly explain that tutorial, and I know it will help many struggling beginners. So guys, these are smart money concepts, the same concepts big banks, hedge funds, and big institutions use. And there's a reason for that, because of how successful they are. This is not your ordinary indicator strategy. These concepts go deep down to the core of how the markets are structured. I'm going to explain the exact formula so you can copy the style of these trades and use these concepts yourself in your everyday trading. First, we need to go over the structure of a trend to make sure we're using these concepts correctly. Then we'll go over some actual live trades to see the strategy in action. And at the very end of the video, we'll go over a secret trick to make this strategy perform to a whole new level. So to put it as simply as possible, a normal uptrend will look like this, making higher highs and higher lows every time a new high is broken. This is what's called a bullish VOS, or a bullish breakup structure, breaking the previous high. It will then eventually lose momentum and start heading the other direction. This is very important to understand. In order for this to be an official reversal, price has to break this prior higher low, which is right here. Once this move has happened, that is called change of character, which can identify when a reversal is about to happen. Now you'll see these absolutely everywhere you look, but what we're looking for is something extremely specific. In order to make this change of character significant, we want this previous high to be in an area of interest, for example, a supply or demand zone or an order block. The stronger this area of interest is, the better. This will significantly increase the success rate of the change of character. It gets the job done, but it's still a kite in the end. But if you grab that same change of character and add a strong area of interest to it, once we have a change of character in an area of interest, we can expect price to start heading in the opposite direction downwards, making lower highs and lower lows, creating bearish break of structures. Then once it comes to the bottom, it'll repeat the whole process again by creating a bullish change of character. So that's the idea behind the strategy, very simple. But there are some specifics we have to go over to make this strategy as successful as possible. First, the most important thing is you need to locate a key area of interest. We want this area of interest to be as strong as humanly possible. The stronger it is, the more likely the chart will move in the direction we want it to. So what do I mean by strong areas of interest? Well, there are a couple things you can look for, but I'll show you the best performing ones. The first one is a liquidity grab and a key supply or demand zone on a high time frame. What you would do is go on a higher time frame like the 1 hour or above. The higher the time frame, the stronger the area will be. Next, you want to find a very key area of supply or demand. You can find this by finding areas where price rejected multiple times, like here for example. What you want is price to do a liquidity grab. A liquidity grab is simply when price breaks this recent high or low, does a fake out, and reverses in the opposite direction. The reason we want a fake out is this. There are going to be people entering long positions of this recent break, so you know what they're going to do. They're going to set their stop losses here, So if price does end up doing a false breakout, once price comes back down it'll hit all these stop losses, adding fuel to the fire and increasing the momentum and the likelihood of the price continuing to head down, which we can take advantage of by entering a short and making that sweet old cash. As the chart tanks. Keep in mind you can do the exact same thing with long trades, you just do the complete opposite. So a false breakout or liquidity grab on a higher time frame is the first example of a key area of interest. The second way you can look for a key area of interest is by finding an order block. An order block is basically an area where the big money institutions like to enter or exit. These areas are high interest because usually priced as strong reversals at these levels because the amount of money that's entering or exiting, which is exactly what we're looking for. Let's get back to the video and go over some live trades for this strategy. Make sure you're on a higher time frame like the 1 hour. One of the key things to look at are these low and high lines. These are the lines price needs to break and do a liquidity grab at. Like I was talking before, if you wanted to do it manually you would just zoom out on a higher time frame and find where price is rejecting or getting supported a lot. So you would make that line and that's the line price has to do a liquidity grab. Here the indicator does it for us. If we want to do a short, we want price to do a liquidity grab at the high. If we want to do a long, we want price to do a liquidity grab at the low. Here's a live example with the trade I took myself using these exact same concepts. So the very first thing we look for is price to do a liquidity grab or a false breakout. Let's see what happens. Price came up to this area of interest, passed it and rejected. So this is the liquidity grab we are looking for. Since it was a bearish area of interest, we will look for signs to enter a short trade. The next step is we need price to make a change of character. If you're doing it manually, just follow the guide I said at the beginning of the video. As you can see, price fell very hard after doing this liquidity grab and made a gap while falling down. This is very important. So keep this in mind for later. After that it falls a little more, creating a change of character. This is step 2, completed price must make a change of character after the liquidity to grab or the signal is no good. So we have 2 indications this is a good short. Next we need to know where to enter. What I like doing is entering on a fair value gap or a gap in general. A fair value gap is simply when price falls or goes up so fast that it doesn't give buyers or sellers enough time to enter the market, which creates an imbalance in the market. Oftentimes price will want to come back up or down to this fair value gap and reject. You can have a bullish fair value gap and a bearish fair value gap. They make very great entries and are usually extremely strong. You can mark a fair value gap by taking the previous candle's wick before the big move, then taking the next candle's wick after the big move. This rectangle area is the fair value gap itself. If the big move is moving down, it's a bearish fair value gap. If the big move is moving up, it's a bullish fair value gap. Now if you trade stocks, oftentimes when price falls or goes up super fast, it'll create a gap like the one here. This basically has the same functionality as a fair value gap. This chart is a stock example. There are gaps on this chart so we will be using them in this example along with fair value gaps. So now that we have a liquidity grab and a change of character, what we want is price to come back up to a fair value gap or a gap after making a change of character. This gap right here will work perfectly as price will most likely want to return to this point because there's an imbalance in the market at this area. Let's see what happens. Price comes back up to this gap just like we thought it would. Now if you want to be in the trade, for sure you can enter right at the beginning of the gap, so you would enter a short right here. If you want a little better entry, you can wait for price to come up to the halfway point of the gap, so you would enter right here. I find a lot of times price will come to this halfway point and then reject. But just keep in mind, sometimes price will only come to the starting point of the gap and if you are waiting for the halfway point, you would have missed out on the trade. So in the end it's up to you which way you want to do it, but those are the two different ways you can do it. So price made a bearish liquidity grab, a change of character, then came back up to a normal gap or a fair value gap. This is where we enter our short trade. We set our stop loss at the high of this move. We set our take profit at the low. What I really like about the strategy is that it gives a great risk to reward ratio basically every time, which is super great. Let's see what happens. It was a winning trade. Now just to prove to you how successful this strategy really is, I'm simply just going to stay on this chart and you can see, 1, how often this happens in the market, and 2, how successful this strategy really is. So you can see once price hit or take profit while doing that, it actually broke our low line and rejected, creating a bullish liquidity grab. So we can start looking for a long trade. Now the next thing we need is a bullish change of character. Let's see what happens. Price ends up going up and making a bullish change of character. That's step 2 completed. Now we need price to enter into a fair value gap. As you can see, price created 2 bullish fair value gaps as it was going up previously. Now here's a little rule of thumb: if you want to be on the safer side, you should wait for price to come down to the lower fair value gap. So this one right here, just know price will not always do this and will end up rejecting on the higher fair value gap. So you wouldn't miss out on this trade if you're waiting for the lower one. I usually just do the first fair value gap, so this one right here. But if you want better entries and better risk to rewards, wait for the lower fair value gap. Just now you may miss out on some trades. So we wait for price to hit this fair value gap, which it does. We enter here. You can set your stop loss right below this move or set it all the way below this liquidity line. It really just depends on your personal risk tolerance. Either or will work, but I'd recommend doing your own testing. After we set our stop loss, we set our take profit at the high of the last move and look what happens. Another easy trade. Oh, but wait, we aren't done yet. As you can see, when price hit or take profit, it did another liquidity grab from the previous high. So we keep our eyes out for another potential short. We see price make a bearish change of character. So that's step 2 completed. Next, all we need is for price to come back up to this bearish fair value gap for our entry, which it ends up doing. We enter here, set our stop loss either at the high of this move or set it all the way above this liquidity grab. Depending on your risk tolerance, set the take profit at the low of the last move. Let's see what happens. Another winning trade? As you can see, none of these were cherry-picked at all. If you go look at your charts and see a liquidity grab, a change of character, and a fair value gap all in correlation, it brings in a massive success rate. Now here's one more extra little trick you can do with a strategy that performs insanely well. Instead of looking for a liquidity grab, you can use an order block. What you want is price to come to an order block and respect it like this. It needs to respect it. If it breaks through it like this with a big-bodied candle, it's not a good order block. It's okay if it has big wicks going through it like this. It just needs to show signs of slowing down and respecting the order block. Once you see price respecting the order block, you can do the exact same strategy just with order blocks instead of liquidity grabs. So next we look for a change of character, which we get. We wait for price to create a fair value gap and come to it, which it does. We set our stop loss, set our take profit. Boom! More easy money. Thanks for watching and I'll see you guys next time.